Hiya, this is Thinking Solo. I'm Ryan DeRusso, a fee-only financial planner. Today I want to talk to you about the right business structure to select when you're starting your private practice or a solo business. So often when people start that business, that private practice, one of the first things they do is go out and pick the structure. It's important in the private practice space because potentially you could have regulations against you, and you have to make sure that the right structure is in place to protect you. But that doesn't mean that every structure is right for you. And so, how do you define which one is right for you between the LLC, the PLLC, or the S-Corp? It'll depend on many things: the size of your business, the way you're paid, and how much money is coming in. But today we're going to break down a few of those differences and help you make that decision. So hit that like button and let's get started. Before we dig into the right structure for you, let's first kind of get rid of some of the myths of the LLC and PLLC protection. What these entities do or what they are called, are pass-through entities. That means that when you make revenue or income through the business, that money just comes right back to you, and you are taxed on whatever you make. In terms of the liability protection, it's actually quite small. It's quite limited because of this structure. If a lawsuit were to come down, you might be able to protect your home under this structure. But if it's impacting your income, it's impacting your revenues, whatever, well, that's going to pass through to you, so it's going to have a significant impact on you as well. So, when we're forming these things, it's good to have, but we've got to be realistic about the liability protection in place. While the liability protection may be limited in the LLC or the PLLC, it doesn't mean they don't have value. In fact, they have incredible value for you as a solo business owner. When you sign up for one, what you can do is then immediately go to the IRS and ask for an EIN, or an employer identification number. This is basically a social security number for your business. What does that do? Well, it allows you access to business tools like a business credit card, a business line of credit, or the ability to create a retirement account under the business name. By doing so, what you're doing is you're building the credit score of your business, essentially. While it's limited, it's a pass-through entity, so you're going to be at the forefront of, your credit scores will be at the forefront of whatever you're doing. Over time, it can create like a powerful entity from your business, because as revenues grow, then your business entities, credit power, borrowing power grows as well. At the same time, you can open a retirement account, and that's going to save you on taxes while you're also saving for the future. These things are possible because you have that EIN number, and part of the way you get an EIN number is having that business structure. Now let's talk about that other entity you've probably heard of, the S-Corp. So the S-Corp, again, is also another pass-through entity where you're being, you're paying taxes on what comes in, but the uniqueness of this S-Corp is that you can put parameters on what is coming in. And so to really dive into what an S-Corp is and its value, we first need to talk about self-employment tax. And I know no one wants to talk about self-employment taxes, so let's try to make it as simple as possible, and let's just talk about the idea of marshmallows. So when you are working for an employer, that employer pays you a whole bunch of marshmallows, and on top of the income tax that you pay, what the IRS says is, hey, we want 7.65% of those marshmallows that you're making for future s'mores that we are going to provide for you. And those s'mores are in the form of Social Security and Medicare. The other part of that is your employer pays 7.65% of how many marshmallows are coming in to help fund that future s'mores in the form of the Social Security and Medicare. Combined, that's 15.3%. And when you work for yourself, you have to pay all your marshmallows. You have to cover that whole 15.3% yourself. This is incredibly limiting for someone in self-employment, and that's why it has the idea of the self-employment tax. This is where the S-Corp comes in. Because the S corp, as an S corp owner, you are two entities. You are the owner and you are the employee. And so, with an S corp, you can pay yourself an income just like you would pay an employee. That money or those marshmallows are, you get income tax off of that, and then you also pay self-employment tax from that bunch of marshmallows. But you don't have to put all the revenues into your income. Instead, you can pay a portion of yourself through dividends. What this is essentially you as the owner receiving a dividend for investing in the business. And this is paid, you pay this tax at a 20% rate, which is often lower than most income tax rates. And you don't have to pay the self-employment tax on top of it. So this is incredible savings. It can be thousands to tens of thousands of dollars each year, depending on how much you make. And the only rule really is that the IRS says is that you have to pay yourself a reasonable salary. You need to work with an accountant or financial planner to figure out what's reasonable, but there's real value in having that sort of setup. So far from this discussion, it seems like a no-brainer. You just start an S corp and say la vie. You're off and running. But when you're creating an S corp, there's a lot more complexity to it. It's more expensive. There's other reasons why you don't want to do that. And there's a little trick of the trade called the S-Corp opt-in if you have an LLC or a PLLC, which gives you the opportunity to have the benefits of the LLC, but also get taxed like an S-Corp. All you have to do for this is file a form called the 2553 with the IRS. What this form basically says is, hey, I'm an LLC, I'm a PLLC, but I would like to be taxed as an S-Corp this year. This form then tells the IRS that it says, okay, you're going to be taxed as an S-Corp. And so you can go through the same process that I just described earlier, where you're paying yourself a certain income and then a certain amount is dividends, and you can be taxed in that front. Now, there's certain rules. You have to be able to qualify for an S-Corp, and you also have to be forewarned. When doing this, there's a higher chance that you may be audited or something like that. So you need to make sure you're buttoned up elsewhere if you're going to do that. But it's a very simple way to get the S-Corp status without actually having to go through the process of setting and running an S-Corp. People will often ask me sort of, what type of business structure I use, and I actually do the LLC with the S-Corp opt-in. I think it's the most beneficial. I don't have to do the regular reporting of the S-Corp, but I'm able to get some of the benefits of the S-Corp, and so it's worked really well for me in the past. But you really need to judge it by your own sort of situation and what's available to you, and what you plan for do with the business in the long term and whatnot. But if you're just getting started, you want to get that LLC started, this is a great way to begin, but then also a way to think about tax planning, which will help your business in the long term. But otherwise, that's it. It's a very cool, simple way to save you money, and all you have to do is file a couple of papers, move things around, but it's not a bad way to save some marshmallows. So what approach have you taken? Have you tried this? What was your experience? Let me know in the comments. This is Thinking Solo. Make sure to hit that subscribe button, like the video, and I will talk to you next time.